You've seen fair value gaps, you've seen inverted gaps, you've even seen gaps built from volume imbalances. But what if we could take the concept further? Imagine the concept of fair value gaps not as a static zone on your chart, but as a dynamic oscillator that reveals the strength of market structure, not just areas of imbalance. Well, we've built exactly that. In this video, you'll see a completely new approach to this concept, one that transforms how you analyze price action. Let's jump in. A fair value gap, or FVG, is a price imbalance on the chart that forms when the market moves so quickly it leaves a gap in trading activity. Typically, it appears as a three-candle pattern. The middle candle's body doesn't fully overlap with the first and third candles. This shows that price effectively skipped over certain levels, leaving an imbalance. Traders pay close attention to these areas because price often retraces to fill the gap, creating potential entry points or profit targets. But bullish gaps can sometimes signal bullish trending conditions, while bearish gaps can signal strong bearish trending conditions. By analyzing where and how these gaps form, we can gain valuable insight into overall market direction and momentum. When you first add this indicator to your chart, you won't see the usual highlighted fair value gaps. Instead, you'll see a dynamic oscillator. This oscillator tracks areas where the market moved so quickly that it left behind untested zones, classic fair value gaps, and measures how many of those gaps remain open versus how many have been filled as price revisits them. The oscillator rises when bullish gaps dominate and falls when bearish gaps are stronger, giving you an immediate sense of market bias and momentum. Inside the oscillator, you'll notice small dashes and markers. These appear whenever a new unmitigated fair value gap is detected. You'll also see a gray line running through the center. This is the net value line. It represents the combined balance of bullish and bearish unmitigated gaps. When it's above zero, bullish gaps dominate. When it's below zero, bearish gaps take control. This gives you a clear visual of the market's net directional pressure at a glance. If you want to see the actual gaps forming on your price chart alongside the oscillator, you can pair this with our free fair value gap indicator. This allows you to watch how each new gap detection directly influences the oscillator's readings in real time. In the settings, you'll find a single main input, the fair value gap lookback. This determines how many past gaps are stored and used in the calculation. There are also styling options and two useful checkboxes, one to toggle the FVG ratio display we covered earlier, and one to remove the gradient shading if you prefer a simpler look. Now that you understand exactly how this oscillator works, the next step is learning how to use it to trade with fair value gaps in a completely new way. In this example, the first step is to determine the overall market momentum using the fair value gap mitigation oscillator. The most powerful buy setups occur when momentum is clearly bullish and there are little to no new bearish FVGs forming, exactly like the scenario here. We can see bullish momentum indicated by the green level plotting above zero. At the same time, there are no recent bearish fair value gaps, shown by the red line remaining flat near the center of the oscillator. The net value line is also aligned with the bullish reading, confirming market strength, and we're not yet in an overbought condition. Together, these factors create an extremely strong confluence for a long trade. From here, we wait for price to reject a bullish fair value gap, like it does in this example, and then set up a 1 to 2 risk to reward trade. These are some of the most high probability setups the oscillator can provide, offering both precision and confidence in execution. This oscillator can also be used to accurately detect retracements within an existing trend. In this example, the market is clearly in an uptrend, confirmed by the net value line holding above the midpoint. However, we start to see some bearish fair value gaps forming, signaling a minor pullback within the broader bullish move. In these situations, the oscillator becomes even more powerful when paired with a confirmation tool like the oscillator matrix. Its hyperwave confirmations are excellent for detecting early trend shifts or the end of a retracement. Once we see a turning point on the oscillator matrix, especially when it appears below the 20 level, where the strongest signals occur, we can plan an entry. From there, we place a stop below the recent swing low and target a 1-2 risk to reward trade. This method is both clean and highly effective for capturing trend continuations with precision. And that wraps up our breakdown of the fair value gap mitigation oscillator, an innovative tool that transforms traditional FVG analysis into a dynamic momentum and structure gauge. It helps you see market pressure, identify retracements, and spot high probability trade setups